Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Champion Iron Limited. Please note you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I am very pleased to welcome David Cataford, Chief Executive Officer of the OTCQX Best 50 company, Champion Iron Limited, which trades on the OTCQX Best Market under the symbol CIAFF, and on the ASX as well as the TSX under the symbol CIA. Welcome, David.
Hi, thanks. We're pretty excited to be able to present today at this conference. Not every day that we're crowned one of the best 50 companies on an exchange. We had that great honor on the TSX and on the ASX, and now here on the OTCQX. I think what's important is to be able to position a little bit our company high level, and then be able to dive into the market dynamics, where we'll be able to position how we're unique and why we've got a great growth trajectory in the next years, and then finish off with our actual performances and our growth initiatives. If we look at Champion Iron, so we operate an iron ore mine, one of the highest grades iron ore mines in the world, in the second largest hub of high grade exports globally. Sometimes a lot of people think of iron ore, they'll think of the Australia or Brazil market, but Canada, as well positioned, has an extensive resource and is the second largest hub of high grade exports globally. What's important to note as well is that management owns just over 9% of the company. So every time we take a decision, we're fully aligned with all the shareholders because we are major shareholders as well. What's important as well is the historic cumulative investments at Bloom Lake were about $4.5 billion US, and we've since invested over $1 billion into the assets. So quite a lot of investments have been made to be able to have a good foundation to allow us to grow in the future. And we've also committed to reduce by about 40% our CO2 emissions by 2030 and be carbon neutral by 2050. And what's interesting as well is this is not just something that we put on a website. We're actually over 30% reduction today from historical numbers and well on track to achieve the 2030 target. So if we start by talking about the market, what's interesting is to be able to position what impact can we have in this whole decarbonization plan. And what's interesting is that steel, well, maybe not interesting, but important to note is that the steel industry produces more than 7.2% of global CO2 emissions. So one of the largest emitters in the world. The mining portion only represents about 1%, if you look at the iron ore mines, of the CO2 emissions. So the bulk of the emissions are really on the steelmaking side. So over 85% of the emissions are done in the actual steel making. So it's important for us to work on our own decarbonization, but as we'll get into, we've got a very large impact working on our scope 3 to allow our clients to be able to decarbonize. What's interesting as well is that we often think of materials like lithium and cobalt because we think electric vehicles when there's discussions about CO2 reductions. But if you look at the actual grid, if you want to be able to convert the current grid or to improve the current grid into more renewables, well, you're going to need a whole lot of steel. And it's forecasted to require about 3.5 billion additional tons of steel to be able to decarbonize the grid by 2050. That's a significant amount of new steel that's going to be required, and we do believe it's going to require some lower CO2 intensity steel to be able to contribute into the decarbonization of the grid. What's interesting as well is that we're seeing more and more sophistication in terms of what is required to be able to actually decarbonize. And although there was a lot of discussions on electric vehicles at the start, there's been a little more discussion on the actual steel and cement side in the recent years. To the extent that at last year's COP28, there's several countries, including Canada, Germany, UK, and the US, that have pledged to procure greener steel or lower CO2 intensity steel to be able to build their public infrastructure. and that's responsible for about 25% of global construction revenue. So it's interesting to see that there's a lot of changes in the actual mindsets to be able to use lower carbon steel. And last year was really the first year that we started seeing contracts that were signed to procure lower CO2 intensity steel. And now we're also seeing governments, which are a little bit more price agnostic when they make decisions like this, to be able to secure low carbon steel. Another interesting element is that Europe's carbon border adjustment mechanism, what they refer to as CBAM, is going to be able to start very soon. So its first phase was in 2023, but we actually start seeing material impacts in terms of taxes from material that comes into the country with higher CO2 intensity, and have companies pay taxes in terms of the embedded carbon in these materials. And iron ore is one of these that will be addressed. So will steel. And what's also interesting is other countries are now also continuing down that path. The US even has one of those bills on the table that should be voted this summer that would also put a similar kind of mechanism in place. And you can imagine that's got a big impact for groups like ourselves, because we've got the lowest CO2 intensity high-grade iron ore in the world. So we'll be much less impacted, and helping our clients be able to have lower taxes in terms of this embedded carbon. Now, why is it so important to produce high-grade iron ore? What impact does it have? Well, there's pretty much two ways to produce steel in the market today. So you can go by blast furnace and basic oxygen furnace, and this is probably the best way to make steel, to produce high-quality steel. Its downside is that it uses quite a lot of coal and produces about 2.2 tons of CO2 emissions per ton of steel produced. So this is why most of the producers use blast furnaces, or used blast furnaces in the past, and why it produces so much CO2 emissions in the world, because you can imagine a market of about 2 billion tons of steel per year, while the amount of CO2 emissions that are produced when you use this route. Now, the alternative that has been demonstrated for decades, so it's not a new technology, is to use DRI and electric arc furnaces. So to remove the oxygen from the iron through a DR shaft, and then be able to melt the material and make the actual steel in the electric arc furnace. The big advantage of this technology is that it reduces by at least half the CO2 emissions compared to the BF-BOF route. The other advantage is that you're able to make steel without using coal. Its disadvantage is that when you want to produce high quality steel, you can't just use scrap to be able to feed into this technology. You have to use pure metallics like DRI or pig iron to be able to dilute down the contaminants from the scrap. You can imagine that scrap, as you recycle material and melt it again and again, because it has contaminants, well, eventually there's so many contaminants that you cannot make the high quality steel that you want. Another impact that we're starting to see is that as electric vehicles are being introduced into the market, well, they've got a significantly higher amount of copper within the actual car. And when you look at the scrap that is produced from those cars, it also has a higher copper content. And copper is a big contaminant in terms of the steel manufacturing. There's even countries that are saying that the car of the future is going to be a square box. It's very complicated to make round steel or curved steel when you have too much copper. So if you want to solve this, there's no way right now to be able to remove the copper. You need to dilute it down with pure metallics. And this is where the DRI or the pig iron come into play. The disadvantage of the pig iron is that it uses the blast furnace to be able to produce the pig iron. So because of that, it produces a significant amount of CO2 emissions. So you can imagine that when countries implement carbon border adjustments, well, that's when pig iron becomes much less interesting, and why DRI becomes the method of choice. And that's pretty much why you're seeing in Europe now, every time a new electric arc furnace is being sanctioned, well, it's coming with a DRI or a DR shaft to be able to produce the DRI. We're not seeing this as much, let's say, in the US for now, but we do imagine that once mechanisms equivalent to CBAM come into play, well, then that could be a trend that we would see in the US as well. When you look at what's forecasted in terms of the amount of new DRI that's going to be required, it's a significant amount. So we're forecasting, when you look at various bodies that look at the global steel markets, the global scrap markets, they're all seeing a significant deficit over the next years. A deficit of more than 100 million tons by 2031. And just to give an order of magnitude, today's market produces about 150 million tons of DRI in the world today. So when you go with a deficit of 100 million tons, well, you're almost doubling the amount of DRI that's going to be required in just a few years. So there's a significant demand increase that is coming for this type of material. To give an order of magnitude, the cumulative historical production of DRI has been about 2.3 billion tons. What's going to be required to be able to reach the various targets that different companies have set out is roughly about 14.4 billion tons between now and 2050. So you can see that there's a significant amount of increase of this type of material that's required if companies are to meet their targets in terms of the steel making and the carbon reductions associated to them. The other interesting portion when you look at the actual market is that it's one thing to have to build DR shafts and electric arc furnaces, but what you need when you use that technology is very high grade iron ore. You can't use lower grade material and be able to produce high grade steel when you go towards the DRI and then the electric arc furnace. And what you see on this chart right here is all the tons of iron ore that are being mined around the world on the seaborne market. And when you look at the green rectangle at the bottom right, that's the quality required to be able to make DR grade material. So you can see that the bulk of the tons that are being mined today cannot be used in the DRI/EAF route. So although there's a big deficit in terms of DRI that's going to come, there's very little projects around the world that can actually produce the type of quality required to be able to make DRI. Just to give an order of magnitude of the impact that we can have when we go down that route, the DRI-EAF, with material like we have at Bloom Lake. Well, if we were to convert all of our tons to 69% Fe, the highest grade type material, we would allow our clients to reduce by 10 million tons of CO2 emissions per year. So if you can just imagine a carbon tax of about 100 euros per ton, if you look at Europe, well, that's an increased value of about 1 billion euros per year that is generated simply by using our material instead of lower grade type materials. You can see that there's going to be a big advantage for various groups to be able to buy material from projects like Bloom Lake. What's interesting as well is where can you actually find this type of material in the world? Well, there's 3 areas that have significant resources that could produce DR grade type material. You have Russia, Ukraine, that is a pretty difficult spot right now to be able to view short-term growth. There's Brazil that have had significant environmental issues, and because of that, they cannot grind fine enough to be able to produce the highest quality. So the quality has come down from the Brazilian material. And then you have Canada that has one of the largest resources of high-grade iron ore around the world. What's important for our clients as well is that when you look at Canada, well, we already have the lowest CO2 intensity per ton of iron ore that we produce. So that really sets us apart when we look at signing different deals with various clients, because we help them decarbonize, but at the same time, we've got one of the lowest CO2 intensities per ton of iron ore that we actually produce. This is mainly due to the fact that we have hydroelectric power. So we looked at the market, we see that there's going to be a very big demand for DR grade type material. This material is very scarce, and this is actually what we produce at Bloom Lake. Now, if we turn to our actual operations, Well, we could see that we're setting new records quarter after quarter in terms of production. In just about 18 months, we managed to take our expansion. So we doubled our production in 2022, and it took us about 18 months to reach nameplate capacity. And not only we reached nameplate capacity, but we also surpassed our nameplate capacity at the previous quarter, producing roughly about 4 million tons of material during the quarter. That would put us on a run rate of about 16 million tons. Now, we have two challenges to be able to achieve those sorts of numbers in the long run. So one, there's some improvements that are required on the rail. We have had some issues with the rail operator, and that is currently being solved. But it's not a capacity issue on the actual rail. It's really just a question of locomotives and rail operators. Rail operators are being trained. The locos have been ordered. So that should be behind us in the coming quarters. But we have accumulated a stockpile of about 2.4 million tons of material at site that will eventually be brought down and sold to the market. Second element as well is that by pushing the capacity so high in the previous quarter, well, that's caused us to have some operational or forecast some operational issues in the past quarter, because when you push the machines so hard, well, then there's various, you note after that the various elements that need to be repaired to be able to eventually reach that kind of increased capacity for the long run. So over the next quarters, we're going to work to be able to solve the various elements at site so that we can increase the nameplate capacity over and beyond the 15 million tons. In terms of cost, well, we've done a very good job in reducing the cost compared to the previous owner. If you factor the inflation compared to where it was in the past, 2013, 2014, we've managed to reduce by about 40% the cost per ton at site. So we found ways to be able to improve structurally the costs at the site and are continuing to improve our costs as we finalize the ramp up of our expansion. In terms of cost, what's important to note as well is that there's a fairly flat cost curve for the first, call it 65% of the market, 65 to 70% of the market. And we position ourselves within the largest players in the iron ore business. And their costs have increased significantly over the past years, about 55% when you look at the industry value and use adjusted cost curve. So what's important when you look at iron ore is that you can't just have everybody look at their own costs, because some lower grade iron ore has penalties, some higher grade iron ore has premiums, and there's your typical 62% index. So what we do when we evaluate cost curves, well, not us, but what various groups like Wood Mackenzie do when they evaluate cost curves, is that they bring everybody back to the 62% index. And that's when, depending on the premiums and the discounts, we shift between, call it the 15th percentile to roughly about the 65th percentile, depending of what that premium and what the discounts are. But you can see that right now we're at a historical low in terms of premiums for the high grade, which is a little bit counterintuitive because high grade allows players to decarbonize. But we see that adjusting potentially over the next years, and that's when we should see those premiums increase and bringing us closer to that 15th percentile in terms of adjusted cost curves. If you look at our balance sheet, we talked on the first slide that we were a company that was well positioned for growth. We said that we had about 4.5 billion historical investments at site, plus call it another $1 billion of investment. And what's interesting for our shareholders is that we're in a net cash position right now. So we've got roughly about net cash of 66 million Canadian dollars. So very well positioned to be able to continue to grow. 2 years ago, we also started a semi-annual dividend of 10 cents per share that we've paid the 5th semi-annual dividend recently. And we've positioned the company to have enough funds to be able to work on our growth initiatives so we can create value for our shareholders through the better product and the increased volume, but at the same time also having a capital return strategy to be able to return some of the capital to our shareholders. We talked about growth. What does that mean at Champion? So in terms of growth, we have being able to increase the amount of tons beyond the 15 million tons per year at Bloom Lake. So this is the most accretive project that we have for our shareholders, because for very little capex compared to a brand new expansion, we would be able to increase tons. We're currently doing the work to see how many tons we can increase, but we believe will be between 17 and 18 million tons per year. So an increase over our 15 million ton current nameplate. And we'll come back to the market in terms of costs and timeline to be able to do that once we finalize the engineering. We also delivered a feasibility study for a new 9 million tons per year project that we delivered recently, and that would allow us to position quite a significant growth project for our company. But we also have product optimization. So it's important to be able to work on volume increase, but we do believe that because when you go to that chart where we plotted all of the quality versus the rest of the world, well, we see that we set ourselves apart, and it's important to work on our own quality, and we can actually improve it to 69%, allowing us to be one of the purest iron ores in the world. So we believe we'll get significant premiums for this, and this is the project that we sanctioned the past quarter that will be delivered at the second half of next calendar year. This is the project right here, an investment of about $350 million US, allowing us to increase half of our tons, or 7.5 million tons, to 69%, allowing us to sell into the DR market, and really setting ourselves apart because we'll have a niche product that is one of the purest in the world that will allow our clients to blend with lower quality materials, hence reducing their total cost of securing metallics, but allowing us to have a much higher premium for our type of material. We had forecasted an after-tax IRR of about 24%, sorry. So this is a project that's extremely attractive for our shareholders. And right now we're still on target to be able to reach the second half of 2025 target to start this extended plant. The second project is the Kami project. As we mentioned, we delivered the feasibility study in January. It's a project that benefits from historical permitting work. It's a project that has access to hydroelectric power, would be the lowest CO2 intensity high-grade iron ore, even better than our current asset because of the improvements that we've made, and allowing us to produce one of the highest grade materials in the world. It's a project that would produce 9 million tons of 67.5% Fe, construction period of about 48 months. It's got a mine life of 25 years. This is just with the initial study, but when you look in the region, there's quite a lot of iron ore. We've got billions of tons of resources, and when you look at our neighbors, they've been operating uninterrupted for the past 50 years. So even if your current mine life is about 25 years, there's potential to improve this down the road. What's interesting as well is that it's one of the only potential iron ore mines that has available infrastructure. Usually when you need to build a new iron ore mine, you need to build a new rail, you need to build a new port. Now we've got available capacity on the rail and at the port, which really allows us to see a potential path for this project in the coming years. Current project right now, if you looked at the 3-year trailing average, has an NPV of 2.2 billion Canadian dollars and an IRR of close to 15%. So we're currently working on ways to be able to improve this project, and we'll be working over the next 2 years on the full permitting process, allowing us in the next years to be able to, one, bringing a partner, because that has always been our strategy, to be able to deliver the project with a partner, being a large steel manufacturer that requires this material, and also working on the next steps so that in the next few years we can evaluate when would be the best time to bring this project in line. It's very well positioned in terms of other projects, in terms of the actual cost per ton, positioning ourselves about in the middle when you look in the projects that have been delivered in the past decade. I'd like to thank all of our people for making this possible, allowing us to be one of the 50 most best companies on the OTCQX. And now turn it over to Michael Marcotte to manage the questions that you might have.
Super. Hopefully you can hear me by now. Thank you, David, for the presentation. There are a few questions coming in, and if we don't have time to address them all, I'd invite people to join us at info@championiron.com. We'll be pleased to address any of your questions. Maybe just the first one, David. Someone's asking what are the drivers behind the large increase in production that we saw year over year, and what are we expecting for the year ahead?
Yeah, so when you look at the previous years, what's important is that when we restarted the mine, we needed to invest in specific areas, being the recovery circuit and also in the mine, to be able to have an increased production. We went from the previous owner had made on its best year about 5.9 million tons, and we managed to bring this up to 8 million tons with the improvements that we made. We delivered that year over year, so in a very stable way, so that the changes that we made were structural and not just short-term elements. We then set out to do an expansion to double the production. That was roughly about a $500 million US investment to be able to double the production. And we managed to complete that in 2022, finalize the ramp up at the end of 2023. So that allowed us to double the production to 15 million tons. When you look at the next steps, we've seen that one of the plants can produce about a 9 million ton run rate in 1 quarter in 2020. Now we saw what the bottlenecks were. We had to deliver our second plant, which we did. Now we're working on debottlenecking these plants because we do see a potential to bring them between 17 to 18 million tons. And that's going to be by improving some pumping, a little bit of the milling, a little bit of the conveyors at site, improving the mining equipment, and allowing us to debottleneck the site. We don't have the full project right now, but as we continue working on the engineering for this, we'll be able to come back to the market with the next steps to improve our nameplate capacity.
Super. Thank you, David. The next question is with regards to capital return and more specifically dividends. Somebody is asking on dividend expectation for 2024. And before we go, I just remind people that Champion has elected in the past to pay dividends on a semi-annual basis, and we've now paid 5 semi-annual dividends of 10 cents Canadian per share. So I'll let you address the expectation forward, David.
Yeah, right now, when we look at the capital return strategy, as we mentioned a little bit earlier, we're really focused on a few elements to be able to improve the quality of our material and debottleneck the plants. And we believe those create significant value for our shareholders. So right now, what we set in place, as Michael mentioned, is a 10 cent per share semi-annual dividend. And we'll be able to reevaluate that in the future as we start delivering these expansion projects and create more value in the company.
Super. We only have time for one more question, but I remind people to email us at info@championiron.com. And just in last minute or so, David, someone's asking with regards to the milestone expected for the business in the year ahead.
Yeah, I mean, 2024 is a very exciting year for us. It's an exciting year for 2 reasons. So one, it's when we actually start to see carbon taxes in places like Europe affect steel manufacturers and have mechanisms like CBAM come in play. So as we mentioned a bit earlier, the premium right now for high grade is at a historical low. But once we start to see these kick in, well, we do expect the premiums to be able to increase either at historical averages or even beyond this. So that creates significant returns for Champion. On the second element, if you saw in the past fall, so in November and in December, Newfoundland and Quebec elected high-grade iron ore as critical mineral. We're going to know this year if Canada also includes it. If Canada includes it, that makes projects like Kami and all other expansions make a whole lot more sense because there's a whole lot of advantages to be able to be on that list of critical minerals in terms of the investments that the country can make, in terms of infrastructure, in terms of the economics of the project because of tax reliefs and different mechanisms to be able to improve the economics to get these projects up in line. So in the coming weeks, we should be able to see if we manage to get on that list. And if we do, that's got significant impacts for us. Oh, you're on mute, Michael. Well, anyways, I think our time is done, so I'd like to thank everyone for being here, and hopefully we'll also make the cut next year, and we'll be able to do this conference again. Thanks everyone for being here.